Hello there and welcome to the first video of this kind, the first episode of Financial Deceptions. I have decided to have this on my channel because as I'm going through more and more public information, I have noticed that there's oftentimes a discrepancy between what the management focuses on and what sounds something very nice and the reality which is not so nice that can be seen through the fundamentals and through the financials. So in this particular example, I have Bark, a company that released its third quarter results. This is the press release. It was released on 9th of February 2023. It is for the quarter ending 31st of December. But basically what you'll see in this video can be applied to other companies as well, larger in size as well. So the first key highlight that the management shares is that they have achieved positive operating cash flow of 5.1 million and free cash flow of 331,000. Not only that, but below there's the following statement. For the first quarter since going public, we generated positive free cash flow. This is a significant milestone, and with 164 million of cash on the balance sheet, we believe that this is only the beginning and our future is brighter than ever. Now we will come back to this statement because this is, I think, the part that the management's commentary it makes it sound that they're making significant progress, that things are moving in the right direction, but I don't think that is the case. And I'll start by looking at the income statement below, because basically if you take a look at the last 3 months, so this is the same period for which they reported positive operating and positive free cash flow. The company's net income is negative 21 million, and it's a much bigger loss than they had the same period last year of minus 13 million. Right, so we have a company that is not profitable, but somehow it's on the right track and it achieved a key milestone, right? Now, to illustrate this, I'll switch to ticker and I'll take a look at the cash flow, so the quarterly cash flow, and I'll start by looking at the operating cash flow. The first thing that you'll notice is, of course, they had a negative net income, so they had a loss every quarter in the last year, a lot after that as well. Go back in time, but let's stick for a year for now. Then we will zoom out. And then we have all of these adjustments to get from there to the positive free cash flow of 5.1 million that they have disclosed. So let's start with that first. Then we're going to take a look at the Capex that's below, which is being subtracted in order to get to the free cash flow. So first, what is cash from operations? Well, that is all the cash that the company generates, and it can be positive or negative, right? Throughout a certain period of time through its operations. So if you take a look at loans and stuff like that, financing wise, those are not included here. Here we have really the core of the business, of course, unless it's a bank, but this is purely the core of the business. So buying raw materials, buying inventory, selling products, paying employees for the jobs that they're performing. And here are quite some adjustments that we see. And of course, accounting wise, this is all correct. So in these videos, I'm not uncovering some accounting frauds. This is all based and in compliance with the accounting standards. So let's start by two non-cash expenses that are significant. First one is depreciation and amortization. So the company has invested in the past, the cash is gone, they have bought machinery, equipment, whatever that is. And then in the next periods, it is being depreciated or amortized if it's intangible assets. But of course, they don't have a cash outflow. So it is included in the net income, but it is not a cash outflow. So here it is being added back. Then we have stock-based compensation, so the expense that the company has for compensating the employees and the management in shares or options. And again, they are not paying cash. And in this case, we're really focused only on the cash movements. So even though it is included within the net income as an expense, here it is being added back. Of course, in my opinion, it is an expense. But again, from a cash point of view, it should not be there. Now, then you'll notice that there are a couple of really significant ones. And this is something that I really want to bring the attention to. Before we move into that, let's imagine that you have an idea to start a lemonade stand, an incredibly simple business. And what you do is in the first quarter of your operations, you decide to invest in all the assets that you need. So you buy the machines that you need, you buy cups, and then also the inventory. So you buy lemons, you buy sugar, just everything that you need. So from a cash point of view, from your operations, in that first quarter, you've lost money. The money is out, that's it. Then in the next quarter, you decide to sell those or to make the lemonade and start selling products. And at the same time, you're not restocking your inventory. So you just use what you have. In that second quarter, you have made cash from operations, right? So from a cash point of view, you receive cash, and because you're not restocking your inventory, it looks extremely good. But to get the right picture of your profitability from a cash point of view, you need to combine the two periods. Otherwise, of course, this is being distorted. And I think this is the case what we have with Bark, but also it can be seen in other companies as well. If you defer certain expenses or if you prepay them in a different period, of course, the free cash flow would be, in my opinion, distorted, but it is not sustainable for that to be the case for a long period of time. So this is what we have in accounts receivable, inventories, accounts payable. So we have positive movement in the cash balance regarding to the change in accounts receivable, which means in this quarter, they received 12.5 million more in cash than the revenue that they have earned. So most likely they have received that cash from revenue they have generated in the last quarter. Inventory, they have not replenished their inventory for this 18 million compared to the previous quarter. And if we zoom out, let's take a longer period of time. What you'll notice is that they had cash outflow for inventory almost every quarter for the last 10 quarters or so. And this is the first quarter when they have a significant positive impact from their inventories. What that means is if we take a look at the balance sheet, take a look at the inventory balance. It went from 72 million to 77 to 102 to 130. It kept increasing. And this is the first quarter when they basically decide, okay, we have enough inventory. Let's pause that for now. Let's use what we have. It's quite comparable with the example of the lemonade stand, where they just use something from the last quarter and they, of course, show a much more, in my opinion, overstated cash from operations that is not sustainable on the long run, because, of course, in the long run, they will run out of inventory. They have to restock and they have to have more cash going to that for that purpose. But obviously, the management can time that decision. Same goes for the accounts payable. In this case, they have a cash out, so they have paid more accounts payable. Probably in the last quarter, as you can see, it's plus 16, plus 17 million. If you defer the payment of certain expenses to the next quarter, even though the expense is there in the income statement, it's not there in the cash flow statement if you haven't paid it out. So these adjustments are purely the difference between the profitability seen in the income statement and the actual cash inflow and outflow based on the cash flow statement. But not only that, if I scroll below, capital expenditure, these are everything that you see here, the management can decide, has the ability to decide on the timing. So if, for example, Bark didn't invest 4 million, but invested 6 million, they would not have had positive free cash flow, right? Because 5 million minus 6 million, negative 1 million. So by deciding to keep the capital expense at this level, they're able to report positive free cash flow. Again, looking in the next year, for example, I don't think they'll have positive free cash flow. I don't think they'll have positive cash from operations, as they need to make these investments in working capital, so especially inventory. So this is in my opinion, a fairly simple example of how the management can influence the timing of the cash, and therefore it influences the way that the quarter looks like. So if somebody looks at one quarter only, solely through the cash flow statement, and doesn't know the different segments, well, it could be deceived. So that person could be deceived, and I think really understanding the different segments is important. But not only that, if I go back to the press release, what you'll notice here is, first of all, this is a significant milestone. I mean, I don't think this is a significant milestone if you shift expenses and the cash payment from one quarter to the other, but okay. And the second part is, and with 164 million of cash on the balance sheet, we believe that this is only the beginning and our future is brighter than ever. All right, let's take a look at the balance sheet quickly. Do they have 164? Absolutely, the cash is there. But wait a second, what about the rest of the balance sheet? What about debt? They have 80 million in debt. They have 47 million in capital leases. They have more than 30 million in unearned revenue, which basically means they have received cash in advance. This is in the form of a subscription. So if somebody pays upfront for the next 12 months, they receive the cash, but they have the liability to deliver those goods in the future. You don't see any of this in the press release. And I don't think that's fair. I think that focusing only on the cash balance is just completely misleading. But again, everything that they have mentioned is correct. Accounting wise, absolutely matches with the numbers. The numbers are not complete, the story is not complete. So as somebody who is looking into this data, it's important to keep an open eye for all of this and not just take the management commentary and trust what is written there. That would be all regarding this video. I hope that you enjoyed it and it was useful. If you have any questions or comments, please do let me know. I'll try to create more videos of this kind that will be short in nature and basically the same principles that we saw here you can apply when analyzing other companies. And basically when looking at the free cash flow, try to zoom out and see how it looks like over a longer period of time, not just 1 quarter and even 1 year. So take a look at a longer period and see how that ties to the profitability of the business. That would be all. Thank you for watching as always until the very end. I'll see you in the next one.